due diligence and transparency in extractive commodity trading, hosted by the Responsible Mining Foundation. My name is Ed O'Keefe. I'm a director at Synergy Global Consulting. Synergy's been a research partner with the Responsible Mining Foundation on their study, and I'll be moderating this session. We've got a great lineup of panelists, and I'm really looking forward to the discussion. So, the commodity trading sector is fundamental in enabling the global flows of extracted commodities, literally helping make sure that we have what we need to keep us fed, housed, watered, and the lights on. But the spotlight of environmental, social and governance, ESG, transparency and due diligence in the extractive industries is increasingly spreading from many of the upstream issues in the supply chain and is starting to shine more brightly on commodity traders. Now, building on their work in the mining sector, the Responsible Mining Foundation therefore set out to ask what's a quite simple question: how well are extractive commodity trading companies publicly demonstrating how they're meeting these ESG requirements and expectations? A simple question, but a challenging one. The sector is often portrayed as being very opaque. Is there even enough publicly available information to answer the question? And the commodity trading sector is incredibly diverse. Is it even possible to compare the many different kinds of companies and the different roles they take? So I'm really pleased that we've got Jennifer Rietbergen-McCracken from the Responsible Mining Foundation to start us off shortly by giving us a brief overview of the study and its findings. Another question raised by the study is how international ESG standards actually apply to the commodity trading companies. We've got several great panelists with us today to share their perspectives on this question, including Benjamin Katz from the OECD's Centre for Responsible Business Conduct, to particularly talk about their experience in relation to the responsible mining supply chain due diligence guidelines. And also from Eiti, we've got Inês, Schjølberg, Marques to talk about their work in relation to just transparency and the relationship between commodity trading companies and government. And from the Basel Institute on Governance, we have Juhani Grossmann to talk about their work on green corruption and how it relates to the commodity trading sector. We'll also be asking, what are the drivers for change for improving ESG performance in the sector? What's the role of investors in improving disclosure in the sector? And we've got Camille Maurs here from ING to give us a perspective from the financial sector. Finally, how might improved transparency actually lead to improved practices? And we've got Olle Ostensson who'll be helping us answer this question. So after Jennifer has introduced the study, each panelist will speak for around 5 minutes to introduce themselves and the topic, and then we'll move on to an open question and answer session. So do please put your questions and answers in the function at any time. This is in the bottom right of your computer if you're on your computer, on the top right on the smartphone, and we really look forward to hearing from you. So now, Jennifer, I'd like you to start us off with talking through some of the overview and the findings from the study. So Jennifer, over to you.
Many thanks, Ed. I'll just be sharing my screen, so I hope you can all see this. Okay, we're off. So this study was published by RMF, as Ed said, just last month, and it assesses ESG due diligence and public disclosure by companies trading metals, minerals, oil and gas. And in terms of the rationale for the study, well, these companies obviously play a huge role, as Ed said, in maintaining global flows of these resources. So their ESG due diligence is critically important, not only for sustainable development in the countries of origin, but also for the integrity of the international finance system. And in terms of the value added of the study, well, it is perhaps the first independent assessment of what companies are doing on these issues. and it provides learning tools to support improved practices and stronger implementation of existing guidance. This guidance includes, of course, the OECD guidance that effectively set the benchmark, and the UN guiding principles that provide the overarching framework for human rights due diligence. Then more recent guidance, particularly and specifically for the commodity trading sector, comes from the Swiss government in relation to the guiding principles, and from Eiti regarding public reporting on payments to governments. And the study really was designed to align with these guidance tools and to amplify their impacts. The study includes these 25 companies, and it seeks to level the playing field by actually assessing all companies against the same benchmark. And the company scope is quite broad. It includes not only traditional trading companies, but also integrated companies and the trading arms or trading subsidiaries of international oil companies, all of which trade significant volumes of third-party products. The study also includes publicly listed companies, privately held companies, and state-owned enterprises. And the map you're looking at here shows the range of home countries where these companies are registered. Now, what we can't map, unfortunately, is the geographic footprint of their trading activities. In fact, we found very little corporate disclosure of either their source countries or their transit countries. And the study, which is based on public domain data, covers these four broad themes of human rights, corporate governance, financial flows, and the environment. Two things to note here. Firstly, the questions we asked were necessarily of quite a generic level, given the wide range of companies involved. And secondly, the scoring system captured basically any evidence of ESG due diligence processes. So all companies could be expected to show up in the results. And certainly many of the companies could be expected to score well on these quite basic questions. Now, I've selected a subset of the results that speak to the topics of our conversation today and that follow the framework of the OECD guidance. And talking of the guidance, we observed that a number of companies have unfortunately misunderstood or misinterpreted the guidance as being only applicable to conflict minerals, whereas it's been clarified for some time now that the guidance is relevant to all mined commodities as well as oil and gas. This chart then shows the overall results across the 25 companies on evidence of systems to address three types of supply chain risk, namely human rights abuses, illicit financial flows, and environmental impacts. And as we can see, the results are generally low, with 9 companies scoring 0 and an overall average of less than 25%. But what is perhaps more interesting is that collectively, this cohort of companies is showing it can be done. It is possible to demonstrate systematic action on ESG due diligence. Indeed, if one company was responsible for the top scores seen across all the indicators in the study, it would achieve what is shown here in this blue line, i.e. nearly 90% of the maximum achievable score. So this really shows that it's within the company's reach to considerably strengthen their ESG due diligence, simply by adopting the better practices already demonstrated by their peers. Then if we break down the due diligence results into these 3 areas, we can see 2 general findings. Firstly, companies are better able to show that they have set ESG requirements for their suppliers than that they follow through by assessing and managing supplier compliance with these requirements. For example, we found little evidence of companies embedding their requirements in supplier contracts, or engaging with suppliers, or commissioning third-party audits of high-risk suppliers. The second thing we can see here is that the results are slightly better for due diligence on illicit financial flows. And this is likely explained by the more widespread regulation on financial integrity than on human rights or environmental risks in supply chains. If we then unpack the results on human rights, we can see that in general, the further along the due diligence sequence we go, the weaker the results become. And evidence is particularly weak on companies on companies tracking, reporting, and reviewing their performance on how they're managing human rights risks in their supply chains. Then underpinning the whole due diligence process is the identification of high-risk countries. And here we see the results are quite mixed. Indeed, less than half of the companies can show evidence of systems to identify high-risk producing countries, and still fewer show systems to identify high-risk transit countries. Finally, a few words relating to financial flows. One of the more striking results we found shows that disclosure of payments to governments is far from becoming the norm in this sector. Only 3 of the 25 companies show any evidence of disclosing these payments that relate to purchasing commodities from the state's share of production. Information on these payments is, of course, of strong public interest, given the scale of the payments and the corruption risks involved. And the results are similar for both disaggregated disclosures of payments in EITI countries, as shown here, and aggregated disclosures of payments in non-EITI countries. Now, this is one area where I think we can expect to see movement, as the EITI reporting guidelines offer a useful framework for disclosures in both EITI and non-EITI countries. The results on disclosures related to trading contracts are even more stark, with zeros across the board. Indeed, no company has even committed to support such disclosures, and no company has even disclosed the government or SOE counterparties with which they trade. I'm going to close now with a few final words on the drivers of better performance, because we're often asked if we have found any correlation between where companies are based and how they perform in the study. And in fact, we found no such correlation, and neither is there a correlation related to the company size or company type. What does make a difference is, firstly, company leadership on ESG matters, and particularly on issues where regulations are not in place. And as we've heard in other sessions this week, regulations and binding requirements do play an important role in driving change. And then on the last bullet point, overall, some of the better performing companies have been involved in high-profile controversies in the past. And it seems that they've responded by improving their ESG due diligence and their transparency on ESG issues. And with this in mind, one of our key recommendations in the report is to encourage companies to take proactive measures now to implement and demonstrate robust ESG due diligence, rather than being forced into action once a major impact has occurred and has come to light. And Ed, I know you posed 2 questions at the beginning there, so I'll just answer them very briefly. Was there even enough data to do the study? Well, there was actually a considerable amount of information that we found in the public domain. And the document library we can share the link to has over 1,000 documents that we actually sourced and scrutinized, coming either from company sources, from other data repositories, and from information companies provided during the actual study. And finally, is it possible to assess and compare the results across such a diverse set of companies? I think we can say that the measurement tools stood up to the test in terms of being able to assess policies and practices of these diverse companies in a comparable manner, and at least at this relatively generic level. So with that, I'm going to stop sharing and pass back to Ed.
Jennifer, thanks very much for that overview and for getting us started. So I'm going to turn to each of our panelists now for a short response. Let's start with Benjamin Katz from OECD. Benjamin, could you just briefly introduce the work of your team at OECD in relation to commodity trading, and also tell us a bit about the work that you recently did looking at the uptake of the OECD due diligence guidelines in a broad range of companies? What do the findings tell us about how commodity trading companies are doing in relation to other companies? And how does this compare with the findings of the RMF study? So maybe if you can just help us put the results in a bit of a wider context. So Benjamin, over to you.
Sure, thanks Ed, and thanks so much for inviting me and also for organizing this session, and to the RMF, of course, as well. I think all of our partner sessions, including this one, are really enriching this week, this forum week. And it is excellent timing that this RMF study has come out now. Perhaps some of our participants today did catch the opening of the forum a couple days ago, at which we did present results from our own study on uptake, and which, yeah, I look forward to in a couple minutes sharing a couple of the high-level results from that for those who didn't catch the opening. But I definitely see a lot of commonalities there. Also complementarities in terms of the respective methodologies of the studies. So just to begin with, kind of framing this within the work that we do generally on commodity traders. Commodity traders are of course a critical node in mineral supply chains. While the due diligence guidance does not consider commodity traders to be the choke point or the control point in the supply chain at which it's appropriate to conduct step 4 audits. Many do compare them to control points simply because of the structure of the market, a few traders being present in major commodities and having significant market share. I think what distinguishes them from some SORs, some smelters and refiners, which we do consider the control point for most supply chains, is that many traders are present. They have operations spanning really the entire supply chain, moving minerals, moving ore, moving concentrates, moving metals. And so their ability to help us increase transparency over supply chains in general, there's a great potential there, and some of it definitely untapped. In terms of our work with commodities traders, we do work bilaterally with them on policy advice, on helping them as they consider how to establish and carry out a due diligence policy. We've conducted some trainings for traders at different segments of the supply chain. And we also actually provided input into the guidance that Jennifer showed, and which was a basis for some of the indicators of RMF's study, the guidance on implementing the UNGPs for commodities traders. And then, yeah, I think going forward, in terms of that bilateral engagement, and multi-stakeholder engagement, I mean, commodities traders are also really important for the debate on de-risking for companies that are disengaging, on a blanket categorical basis from either high-risk areas or what are considered high-risk types of supply, ASM. A lot of companies put into that category, but of course, that completely runs counter to the objectives of the due diligence guidance, which is really meant to be a tool for responsible engagement in high-risk areas, and has specific guidance, as many are aware, for engaging responsibly with ASM. And of course, risks also are not confined at all to ASM. So that's an issue where commodities traders can play a major role. And I think we've seen different strategies emerge in the sector, and I'm not sure we've landed yet. I'm not sure we've landed at kind of an equilibrium in terms of sort of a consensus or sort of an industry, kind of a common industry approach to this issue. We see some commodities traders really engaging in high risk areas and with ASM, and others maybe taking some baby steps in that direction, but still, I think, with a lot of room to go and a lot of room for clarification. So just now to get to our own uptake study is sort of think, put these studies in context, I just wanted to share one or two slides from the study. So I'll share my my screen. Yeah, I mean, just to quickly mention the methodologies. The methodology was roughly the same in terms of, to my understanding, in terms of relying on public disclosures for data. So this is all corporate self-reporting. This is not sort of looking under the hood of company practices, but the sample was quite bigger and also more diverse. So we covered really every kind of company producing or sourcing metals. We covered 503 companies. And then what I really wanted to show you was this slide. So you only see 4 steps here because step 5, of course, is that reporting. And so that's our source of data for the other 4 steps. And I think really where we see parallels with RMF's study is that we see actually a lot of strength and growing strength and performance when it comes to management systems. So policies, codes of conduct, due diligence systems, they all fall into this category. And of course, companies have made a lot of commitments to due diligence, and I think that shows in the RMF study as well. But when it comes to actually following through on those commitments, we're a bit disappointed, especially with disclosing to any level of detail how companies identify risks, a little bit better on responding to risks, and of course, audit programs are making some inroads with companies' certification systems. But really, I think the core of how companies identify and respond to risks, which is critical to implementation of the guidance and actually having an impact, that's something where we see weakness. And then just a couple other observations about commonalities between the studies. We also found that geography is not as important as we may have assumed, although we did find a link with legislation, but a lot of companies, of course, are exposed indirectly to legislation. So to legislation in their supply chain, but not necessarily in the country in which they're based. So that appeared to be significant. And like the RMF study, we also saw a great deal of variation in performance. And since our sample was broader, just thinking about downstream sectors, for example, we found very high performance in sectors like consumer electronics, auto, semiconductors, and many others, close to nil. So we saw that, and also at the SOR level, smelters and refiners, we saw somewhat elevated performance among commodities traders. Similarly, a couple scored very well. One actually scored 100%, and a couple others scored almost 0. So again, that variation, I think that came through also in the RMF study. So thanks a lot. I'll stop there and look forward to others' contributions.
Great, Benjamin, thank you very much for that. That really helps sort of put the study in a wider context, and just sort of, yeah, it's great that you're sort of echoing some of the findings as well. So Inês, let's move to you now. Could you briefly introduce the work of EITI in relation to commodity trading, in particular the sort of requirements which are relevant to them and engagement that you've had with companies to debate with trading companies to date, as well as any reflections that you've got on the findings of the RMF study. So Inês, over to you.
Thank you so much, Ed, and thank you for the opportunity to speak at the session. It's really exciting, and we're excited about the findings from the study. So the EITI, the Extractive Industries Transparency Initiative, is the standard for transparency and accountability in the oil, gas, and mining industry. It is implemented by 55 member countries through a multi-stakeholder process in each country. And for those of you who might be a little bit less familiar with the EITI, our standard does require disclosures across the extractives value chain to allow stakeholders to better understand how the industry and the revenues from the sector are managed. And while the focus of the EITI used to be more focused primarily on the upstream sector, stakeholders in research-rich countries have increasingly called for improved transparency of the sale of commodities by government and SOEs to companies, given the significance of these payments and also the potential governance risks involved. So disclosure to date demonstrate the importance of these payments for governments. Almost half of the $2.5 trillion in payments disclosed by EITI members are from the sale of commodities, and significantly outweigh the taxes and payments to governments related to upstream operations. So these disclosures are pretty key in our experience to show the full picture of revenues from oil, gas, and minerals. So what the standard requires is that governments should disclose information on the commodities sold and the revenues they collect from these sales, including details on the companies buying the oil. And this typically means that state-owned enterprises will disclose the volumes of the commodities sold and the revenues received, broken down by buyer, by sales agreement, and ideally by cargo. And given that this requirement has been developed jointly by governments, state-owned enterprises, industry, and civil society, and has been tested for years, this requirement provides a pretty good starting point, I would say, for governance and ESG indicators seeking to measure transparency practices of trading companies. So on the findings of the report, obviously it's really interesting to see the measures that we focus on a lot on disclosures by companies, which we encourage companies to match the disclosures by governments. So it's interesting to see these alongside other due diligence efforts, recognizing that disclosures of information is one thing or one piece of the picture, and that is important to help prevent corruption risks. But it's great to see how this complements due diligence measures by companies that can help also more directly address some of the potential corruption risks. And on the findings themselves related to payment to government, of course, they are somewhat disappointing, but perhaps not too surprising, given that these disclosures are still being done on a voluntary basis and the practice is still emerging. And I think, as was recognized by Jennifer, there are some companies that have been leading the way of these type of disclosures as part of their annual reporting. And we have seen some progress being made since we launched our disclosure guidelines for companies buying oil, gas, and minerals for governments in September last year. And companies such as Glencore, Gunvor, Trafigura, and more recently Total have disclosed details on their payment to government for commodity purchases. And we are hoping to see more disclosures in the coming year. One more area that I did also find particularly interesting in the report was, and also where performance appeared to be mixed, was on corporate governance and beneficial ownership reporting. So understanding how trading companies are structured, which entity or subsidiary is buying the product in individual countries is really useful for stakeholders to understand, first of all, just how the company operates and how the financial flows related to the sale or purchase of a commodity are managed and might involve different jurisdictions. So quite a lot of efforts have been made by EITI member countries to improve transparency and beneficial ownership in the extractive industry. And it's really good to see that here that there's some focus also on ownership transparency in the trading industry, which we also do encourage companies to improve their disclosures of.
Inês, thank you very much for that. So disappointing, not surprising, but real progress being made and lots of opportunities. I think there's sort of echoing some of the issues raised by Benjamin and Jennifer already. But thank you very much, Inês. So Juhani Grossmann from the Basel Institute, I'm going to turn to you now for a question. Could you just briefly introduce the work of the Basel Institute in relation to your work on green corruption, and discuss the connection between disclosure of information and improved implementation, particularly in relation to the commodity trading sector? And also what stood out for you in the RMF report, and where do you see the greatest challenges? So Juhani, over to you.
Thank you very much, Ed. Thank you for inviting me. It's a pleasure to be here and to have the opportunity to comment on this fantastic report produced by the Responsible Mining Foundation. I wanted to just very briefly outline this, why we as an anti-corruption organization, which the Basel Institute are here. And that's because our institute, which focuses both on the enforcement side and the prevention side, so looking at investigations, prosecutions, collective action, compliance. On the anti-corruption side, we're trying, for the last 2 years or so, we've been applying that expertise to the environmental sector. So we're continuously looking at the linkages between environmental goods and integrity issues, and how anti-corruption tools might help with environmental concerns that exist. This is a growing industry, if you will, but still relatively niche. And so we were very pleased to see the study from RMF, because it looks at transparency and accountability very closely. And of course, those are key pillars of any effective anti-corruption and corruption prevention program. So congratulations to the authors for the idea in general, but also for the simple and elegant methodology. I wanted to take a few minutes to make some observations, and starting with obviously my observations would be focused on the corruption section of the report, and starting with the positive. Obviously it's great to see that the companies surveyed, the company studies have compliance officers, most of them with direct access to the board. That's an important element. Unfortunately, in this section, there aren't a whole lot of positives to look at. And so I have to now turn to the slightly more concerning elements, slightly more concerning findings of the report. And of course, starting with the fact that the evidence about what companies are actually doing to avoid bribery and prevent corruption is very weak. And that's somewhat striking if you think about it, because of the regulatory prioritization of this issue and the astronomical fines that are associated with it. And certainly the industry's image, as Ed mentioned in the beginning of the presentation of the webinar, of being shrouded in secrecy, isn't helped when it is accompanied by a lack of disclosure of information related to their anti-corruption measures. Inês mentioned beneficial ownership, super important element, of course, and somewhat disappointing to see how few companies actually disclose their ultimate beneficial owners. We see, I think, very clearly in the report that self-regulation and voluntary regulation are insufficient in this sector, to be honest. We see that the senior management, I thought that was a very important finding, that the senior management have some incentives related to ESG, some performance metrics, but nothing that directly relates to preventing corruption. And so if you think about it, it's not terribly surprising that only half of the companies have made explicit commitments to prohibit bribery. That's a really basic thing to do. I used to spend a lot of time in Indonesia, where I last year surveyed small and medium companies, and I noticed a relatively similar share of small and medium companies that don't have those kind of formal prohibition in place. But that's small and medium local companies in Indonesia versus some of the biggest companies in the world. So that seems to be a very low-hanging fruit that they haven't taken advantage of yet. Also, in terms of due diligence, the embedding of norms and contracts was mentioned earlier, or the lack of thereof rather. Again, that's a really basic thing to do. We're not talking about the actual sort of digging and verification, just the embedding the norms in contracts, and still that's not done. What we've seen in the gold sector in particular is that even where those norms are embedded, they typically are limited to checkboxing rather than actual verification. Finally, and perhaps most important, most companies don't show evidence or are not disclosing any information on the performance of their anti-bribery and anti-corruption systems. So that means basically we don't know if whatever measures they have in place work or not. And that's not great. But even more worrisome to me is that I get the impression that the traders themselves don't know if their systems work, which is really problematic. So in conclusion, clearly there is not yet a strong commitment to corruption prevention. Given the complexity of the business, it's really unforgivable that even very basic measures such as prohibition on bribery or embedding norms into contracts isn't practiced. And as a result of that, I think that all the efforts that are taking place, including the recently released FAQs on preventing corruption in mineral supply chains by the OECD, and many other efforts that panelists and others are making to help smaller companies and medium-sized companies in source countries practice better due diligence, better compliance. It's really hard to put expectations on these companies if we don't even see the biggest companies take the basic steps. So with that, thank you very much again for inviting me, and I look forward to the questions from the audience.
Juhani, thank you very much for those insights, really good. And like Juhani said, please do keep sending your questions. I can see many of you sending through great questions for us to follow up with the panelists afterwards, so do please keep those coming in. Now I'd like to move over to Camille Maurs from ING Bank. Camille, can you introduce yourself briefly, talk about how, as banks are playing a key role in advancing ESG in this sector, what does that practically mean for ING? How do you engage with your clients on these issues, and how does the OECD guidance and RMF study help you in doing this? So Camille, over to you.
Thank you, Ed, and thank you very much for inviting me today. It's a real pleasure to participate in this conversation. So my name is Camille Maurs. I am a Senior Relationship Manager at ING Bank in Geneva. I am part of the Commodity and Trade Finance team in charge of the large traders. I also coordinate various initiatives internally around ESG and sustainability. So ING is basically one of the main player, one of the largest player in the trading and commodity finance space. We are a leading role, and basically we have an influence on the market. And what we want to achieve, we really want to encourage our clients to identify ESG risk rising through their supply chain, be transparent about it, and basically demonstrate that they have ability to manage and address the issue. So to achieve that, we very much value engagement, because we think that this is how we can have an impact. So in practice, what does it mean? We have set up a dedicated environmental and social risk framework. This is a 70-page document. It's available in the public domain. We are one of the very few banks that fully disclose our policy. And so we basically define the scope of our engagement through this policy. We also update this policy on a very regular basis to make sure that we will comply with the best standard in the industry or internationally. So in practice, it means that each client and each transaction is screened through a dedicated risk matrix. By doing so, we want to assess the degree of ESG risk, and this shall define ultimately how deep we want to engage on this matter with the client. If during that process we flag material ESG risk, we will carry additional due diligence work. What does it mean? We will look at more closely at the client's primary supply base, its country of origin. We will look at the client's governance in terms of ESG management. We will look at its policy, due diligence processes. If following this process, we are comfortable enough and we decide to go ahead with the relationship, we will quite often set some conditions that we will monitor through time. A typical condition that we will have for a company active in the trading business will be to have a responsible sourcing policy based on criteria which are relevant in terms of ESG for the industry. We will often refer to international guidance, such as the OECD guidance for responsible supply chain. We also exchange on best practices with the most mature player in our portfolio, and this can translate into sustainable finance transaction. Sustainability is at the core of our strategy. We are actively steering our portfolio to meet the Paris Agreement target. We have developed a science-based methodology for that, which we call the Terra approach, and it's also available on the public domain. We make very regular reporting on the progress report on this methodology. We are also a leading bank in structuring sustainability improvement loan, which basically means that we incentivize financially a company if it managed to improve its sustainability rating or, for instance, meet a certain set of ESG-related KPIs. For a trader, typical KPI we would look at could be reduction emission targets, commitment to have a sustainability certificate for certain product, or undertaking to invest part of their equity in renewables. So to conclude, I think we can say at ING we are very fully committed and we want really to move the ESG agenda for clients forward, but we need help for that. We need to have a comprehensive debate, and I think that's where reports like you produce, but also guidance which like the one of ECD help to bring the debate forward and make it happen. So I will pause here and very much look forward to further exchange in the Q&A session. Thank you.
Camille, thank you very much for sharing your insights from the finance sector side of things. So I'd like to move on to our final panelist now. So Olle Ostensson, could you just introduce yourself briefly and let us know, in your experience, is sunlight the best disinfectant? Do more responsible practices inevitably follow from improved transparency? And how do studies like this, which maybe just hold a mirror up to help see how companies are performing against international standards and expectations, how do they create change, not only in companies themselves, but also in wider society? So Olle, over to you.
Thank you very much, Ed. Thank you for inviting me to this webinar. My name is Olle Ostensson, as you said. I'm an economist. I used to work for the UN for many years, but for the past 12 years or so, I've been an independent consultant, working mainly on the extractive industries and various aspects of it, including governance, its relationship with development and with other sectors, taxation, and industrial policy. I should also disclose that I teach part of the course in commodity trading at the University of Geneva, which means that quite a few of the traders now active are my former students. Of course, they are all doing very well in terms of compliance. Now, does transparency lead to more responsible practices? Well, of course, in and of itself, it doesn't. It's a necessary condition. But I think one thing that came out of the experience of the Eiti, and there have been a lot of studies on this, it shows that nothing happens automatically. You can put the information out there, but unless someone acts on it, nothing happens. There are positive effects, but they very much depend on the uptake by civil society, governments, etc. So you need not just to have transparency, you also need to have enforcement, and you need to have political engagement, which is maybe a platitude. Now, the RMF study is a pioneering effort, and the results, of course, may appear a bit disappointing. Trading companies clearly have not come very far. But I think we should do well to remember, first of all, that this is relatively new to them, and also, of course, that the absence of formal monitoring and reporting system does not necessarily imply that nothing has been done earlier. It may simply be that these are sometimes fairly informal organizations with a small number of persons handling a very large number of trades and large amounts of money. But getting back to the fact that it is new to them, you can compare the trading companies to extractive industries, which of course most of them have links or ties to. Extractive industries like mining companies or oil companies, they can be found in one place during a very long period of time. And during that time, they have a large interface, broad interface with local populations, which means that when things go wrong, they are alerted to it and they have to act on them because they plan to be around. By way of contrast, trading companies do usually not have a very visible physical presence. Also, they are not wedded to a particular location. They, of course, appreciate stable commercial relationships, but they may find other commercial relationships more attractive. So they're more difficult to pin down, and they have therefore also been less exposed to scrutiny. However, trading companies are waking up. And it's probably significant that it seems, at least to me, that the ones that have woken up most quickly are the ones that do have links to the producing extractive industry. Maybe it's a case of experience from one aspect of the business seeping through to the other side of the business. The industry as a whole has relied very much on the free rider argument in the debate that has surrounded transparency and responsibility. Basically, what some people at least will say is that, well, if we follow practices that may cost us markets and deals, others will happily pick them up and get market shares at our expense. There is some truth to this, of course. I remember anecdotally being told once by a banker from a particular country that the advent of the equator principles was a very good news to her company, because it had meant that they could pick up a lot of business that other companies, other banks would not touch. Surely there are traders that act similarly. However, gradually, responsibility becomes part of the fabric of corporate governance. If you don't go along, that carries a cost. I will return just in 1 minute to the case of who pays the cost. But eventually, industrial norms change and companies adapt. And I think we'll probably see a similar development as regards commodity trade as we've seen with extractive industries in general. These things take time, but we at least can be very clear about the direction of change. Now, the RMF study is the first of its kind concerning the trading industry. It's a systematic approach. It's a rigorous application of a common assessment system, which means that it actually provides a quite representative picture of what the industry does and does not do. And this makes discussion possible, which is extremely important, because unless we have some clear idea of what is happening, we have absolutely no way of formulating policy proposals or arguments about it. Now, the trading community has not looked itself in the mirror before. Now, this mirror, as Eddie remarked, is being held up to them. And they're looking at themselves and they're asking the mirror who is the fairest of them all. And unfortunately, the mirror tells them that probably it's not themselves. So, traders, what will they do in this case? Well, one thing to remember is that traders love competition. It's not fun to be seen as the one that is doing most badly and that has the worst reputation. So companies with low scores will want to improve them. It was a very good point that was made by Juhani that maybe traders themselves don't even know exactly if their measures work. So this is one opportunity for them to start looking at that. I'm sure that traders in the international trading community will read this report very carefully and they will take action, particularly because, as has also been pointed out, most of the actions that they can take are cheap and they can easily improve their score. And to the extent that this is a score-keeping exercise, they can easily improve their relative position. Again, as I said, they do love to compete. There are also other things happening which I think have served as wake-up calls. The referendum on responsible business in Switzerland last year was definitely a wake-up call for much of the industry. To many companies, I think this illustrated that it is not enough to comply with the letter of the law. If you deviate too much from society's norms, which do evolve over time, the laws may change because your behavior is not seen as acceptable. And I think this very basic truth was illustrated to the trading companies, and I think a lot of them have, on consideration, decided that it may be better to adapt through voluntary due diligence than to have it forced on you. Now, my final issue here is one of who carries the cost. And there's a difference. Often one compares responsibility in general, and you lump all the industries together, and you lump, for instance, bio-friendly consumer goods with due diligence on conflict minerals and so on. But there is a difference between them. I can choose to pay a little bit more for organic fruit. I find it very difficult to pay more for a particular piece of equipment that contains raw materials that have been subjected to due diligence and that are guaranteed, for instance, conflict-free. The problem is that since these goods are sold on competitive markets, first of all, the free rider problem is a real one because the free riders get the same price as everybody else. Second, the other problem is that the costs tend to be pushed backwards through the supply chain. In many cases, and I think this is definitely the case with conflict minerals, the cost of the systems is borne by the people who can probably least afford it. That is, for instance, artisanal miners in Central Africa. I just offer that as a last thought. Thank you very much.
Olle, thank you very much for those insights and sort of, I guess, rounding up our discussion now. So I'd like panelists just to all, if you can all switch on your videos. I think there's sort of questions coming in for all of you. So kind of welcome you all back into the room. So I think we've got some really great questions there. I think if participants can see that we've answered, people have made some answers to those questions already. But I might ask some of your panelists just to sort of talk through some of those areas. So firstly, just to begin with, I think one of the themes, one of the issues that's been picked up is probably a question to Jennifer and Benjamin to begin with, is this issue of geography. I mean, I think in some ways it might have been a bit of a surprise that the geographic location of these companies didn't seem to correlate that well with improved performance or not. I think that's certainly been one of the narratives around this industry. But obviously, you know, how does that reflect? Benjamin, I know you responded to one of the questions. Could you maybe just start off sort of talking through your response?
Sure, yeah. I mean, I think initially, actually, I'm not sure even we expected to see that much significance in terms of geography of companies because there's so many confounding factors here. I mean, first of all, companies, they may be based in one country, but you know, the very nature of our sample was so diverse and so global because we're talking about supply chains here, that their operations span the globe, many different jurisdictions. So first of all, that means that their risk profile, you know, may not really correspond at all to where they're based. I think the second thing is that you know, many companies, they may be in a jurisdiction that doesn't have legislation related to due diligence, but they're still exposed to a piece of legislation indirectly because they're in a supply chain. I think this is especially the case with smelters or refiners, which especially for tin, tungsten, tantalum, and gold did relatively well in our study. And of course, they've been exposed to some form of legislation which is transmitted through customer expectations, and starting with the US Dodd-Frank Act. And of course, there's been recently European legislation on these minerals as well. And then I think the other issue is simply that the factors that were most important ended up making geography less important. So what do I mean by that? I mean, we saw so much variation in terms of performance and quality of due diligence between different sectors, especially in the downstream. So if you have downstream companies, say in OECD countries, in developed countries, who did very poorly, and some on the other hand who did very well, then that's going to end up making geography kind of a wash in terms of its significance.
Great, thanks, Benjamin. Jennifer, any response from you on that?
Yeah, I would certainly agree with Ben that I think there are other factors that are more important than actually that high the geographic factor. From the point of view of our study, we had quite a range of home countries, so there wasn't that many companies in each to kind of do a proper scientific, cross-sectional analysis. I guess the one that showed up most often, of course, was Switzerland, which is not surprising. And again, companies that are registered or based in Switzerland didn't perform, in all the same level. They showed up across the whole performance range. They accounted for some of the better performing companies and for some of the weaker companies too. So I think there are other factors at play for sure. Thank you.
Great, thanks, Jennifer. I mean, I think one of the things that comes across is a sort of an answer of it's complicated, and traders are sort of so interlinked as part of the system, and they're very different beasts to many of the other companies that we've been used to talking about. As Olle said, is the reason, their complexity and the complex nature of them means that there aren't really any simple stories to tell about them. So simply looking at geographic location won't necessarily give us the answer. Now, Inês and Juhani, I'm going to turn to you for some of the questions that have come up. Inês, I know you answered in the text some of the questions around environmental licensing and some of the sort of environmental issues, as well as gender. And there's another question in there around what governments of home countries and international third parties can do to better spell out and pinpoint where those risks lie. So I'm just going to kind of come back to you and sort of ask you about the role of EITI in some of these wider issues, like environmental issues and gender as well.
Thank you. And yeah, I thought that was a really good question as well, because we've been focusing quite a lot on these issues in the upstream sector, and the question was around environmental licenses, and we do have, as part of our disclosures that cover the whole value chain, disclosures on information on licensing, including environmental licenses, related fees paid by companies, and also other types of disclosures where countries disclose information on environmental impact assessments and the type of environmental audits they do in the sector. So that's an interesting, I think, emerging area where we are also soon to launch guidance on this area for implementers in the coming couple of months, actually. So it's a very important topic for the EITI that has perhaps received a bit less focus when it comes to trading companies. Or sort of the trading side has been very much a topic with the focus on the upstream sector and the kind of impacts in the country. So that is one thing that is, we'll be looking for the findings of your report to look at, what might be the links there that we want to strengthen when it comes to transparency of the commodity trading sector. But yeah, on the other question around what can home countries do, what can third parties do, and of course from our perspective, there's a lot that home countries can do, and with, of course, Switzerland has been an active supporter of transparency in this area, and are sort of an engine when it comes to this work in the EITI, although we do recognize the need for a more level playing field, and for other trading hubs to also be more proactive in encouraging and possibly requiring companies to disclose this type of information. And of course, banks, and it's great to have ING on this panel, who've played a role in promoting disclosures by companies like Gunvor, for example. So in particular, banks that provide trade finance can play a good role in promoting payment to government disclosures by trading companies. And we hope that the work that ING has done with Gunvor could be a model of, to make this a more common practice and norm when it comes to ESG criteria for commodity trading companies.
Inês, thank you very much. So I really like kind of Benjamin's opening statement around the massive potential that, you know, working in this sector has got, and sort of Olle's point that you know, things are relatively new. And Inês, thank you for sort of giving us some insight into some of those things that are still in the pipeline and relatively new and coming down as well. So I think it's going to be a really exciting space to watch as some of these requirements roll out, and many areas for potential leverage and change as well. So Juhani, I'm just going to come to you as well to pick up on some of those environmental issues as well, and the link to green corruption. Just sort of any thoughts from you on those sort of widening requirements?
Thank you, Ed. And yeah, on the prevention side, I can only agree with what Inês said, in the sense that more disclosures, and probably more mandatory disclosures, especially in trading hubs, I think are inevitable, frankly, if we are to make any significant progress here. But just to contrast that, moving aside from the prevention element of corruption, although that's where where my home typically is, I think there also haven't been enough enforcement actions, frankly, against the most egregious violations. And there is always a fine balance between encouraging disclosures, encouraging transparency, encouraging control measures inside agencies that tend to work just a little bit better when there's more enforcement actions. And so I think, while of course today's event is primarily focused on the prevention side, as it ought to be, I just wanted to raise that so we don't lose track of it.
Great, thanks, Juhani. So the importance of enforcement action. So Camille, I'm going to move to you. There's a few questions really around sort of, I guess, implementation and enforcement and digging deeper. To what extent, you know, I think there's a question there that really asks, you obviously do your due diligence on those commitments. To what extent and how do you follow up on how those are actually implemented and put into practice by companies? And yep. Also, how do you listen and engage with other parties? So, for instance, if there's complaints or data that come from civil society organizations, how do you respond to that?
Well, no, that's a very good question. Thanks for raising that. So, what basically we do at the very beginning of the screening process, we will of course look at any controversies or complaints which could happen in the past throughout the supply chain. That will obviously lead us to go deeper and potentially mandate third party and so do some due diligence work on the ground, especially when we talk about sensitive areas in certain emerging markets. So that's one thing. Then, of course, when we have the relationship in place, as I mentioned earlier, we often set conditions. One is typically around the responsible sourcing policy. So what we will do basically is that we will say, okay, to go ahead, but subject to this covenant. And what will happen is that we will regularly do meetings with the client, follow up, eventually go on the ground, see how they implement things if the client is willing to share that, and basically assess how progress are made. And so maybe one last thing maybe to mention is that when we also do structure KPI link loan, whereby we grant financing link to certain ESG targets, we make sure that there is a credible corporate story behind, and we always require for those KPI to be audited. And also, if when we structure the KPIs themselves, we have some doubt about whether they are meaningful enough, we will require the intervention from a third-party opinion that will give us comfort as to the credibility of the efforts that are undertaken by the client.
Camille, thank you very much.
Thanks.
I want to just move on to another question that somebody raised, drawing on Olle's point about, you know, some of the least able to the costs are transferred to some of the least able to bear it. But also, Benjamin, you talked about, you know, the role that commodity traders effectively have in dealing with this big complex issue around artisanal mining, artisanally mined minerals in the supply chain. Benjamin, I'm going to start with you in terms of how do we deal with this? You know, what's the role of commodity traders in actually dealing with this issue of ASM? And as you say, without simply disengaging from it, how can commodity traders really engage on this issue around ASM? Because I think it sort of wraps up a lot of these issues around transparency in high-risk countries. So Benjamin, over to you.
Yeah, it does. Thanks, Ed. I mean, the questions, the observations, very timely. We actually, we've released this week a report on the cost and value of due diligence in mineral supply chains, and we have made some recommendations. Although I think, you know, there's still need for a lot more facilitation in terms of identifying solutions to redistributing costs in a more equitable way along the supply chain. I think, though, you know, definitely part of the issue is creating a level playing field in terms of norms and regulations, because one factor really concentrating those costs and who's bearing those costs has been definitely elevated scrutiny of what I would say are relatively few regions and kind of tunnel vision on particular geographies and particular risk profiles, and also this parsing of supposedly kind of clean sources, which, you know, tend to be, which many characterize LSM or industrial mining as opposed to the ostensibly tainted sources being ASM, which of course is a gross oversimplification. But I think where commodities traders can play a role is especially in the sense that they do engage with so many different kinds of upstream suppliers. So their presence is quite broad. I mean, you have traders working directly with miners, industrial miners, upstream traders. So I think, you know, in terms of a lot of traders, they're quite large organizations. They have access to finance that other upstream actors typically don't, and so in that way they can be a conduit in a sense to sources of finance that can be used to invest in formalizing ASM and bringing in a formalization framework into the picture from the vantage point of a commodities trader. You know, I think could help bring about a more equitable distribution of costs, because you're sort of, whether it's in the form of an industry partnership or whether it's on a bilateral basis, you're bringing this, you know, large dynamic player with access to finance itself into the picture. So definitely, you know, we encourage responsible engagement of ASM, including for commodities traders, and I think we're seeing some pretty innovative examples of that in Cobalt.
Great, thanks, Benjamin. I realize we're nearly running to the end of our time, so what I'm going to do is just take some closing remarks, some very short closing remarks from each of you. I think we'll start with Olle, because actually you haven't had any questions yet, and then we'll move around everyone else. So just some brief closing remarks for you, and particularly sort of looking forward. This is a space to watch, and there's a lot of potential for the industry and potential for movement. Maybe sort of looking ahead, where are the opportunities and the changes that you'd like to see? So Olle, just some closing remarks from you.
Thank you, Ed. Well, I think one thing that comes through in this discussion is the tension between responsible sourcing schemes that are more or less voluntary and actual regulation. And I think this is probably where a lot of the debate is going to be in the future. To what extent do we need regulation? To what extent do we need international regulation? And I think the answer is that probably we will have to go in that direction. And I think one of the reasons for it is exactly the point I raised earlier, that unless you have regulation that is binding, and I don't say this lightly because I know that a lot of my friends, for instance, in the trading industry will not like it, but I think we're going in that direction. I think it's probably the only way to ensure that we have that level playing field. Thank you.
Great, thanks, Olle. So Camille, I'll probably move to you for some closing remarks as well.
Yeah, sure. Going forward, we see a lot of regulation, as Olle mentioned, going our way around mandatory due diligence, human rights, climate change. I think the industry is changing. We all see that, and for us, I mean, this will mean definitely even more engagement going forward. I think the society expects us to be actively taking part in this process and bring solution, and I think we are fully committing to do that and do our job. But for the model to go into the right direction, we will need the help of all parties involved. So of course the traders, but we need also the suppliers, the ship owners, the refiners, and obviously, of course, the support of the NGOs like RMF and international organizations like OECD to frame this dialogue.
Great, thanks very much, Camille. Juhani, over to you in terms of closing words and perhaps looking towards the future.
Thank you. Yeah, I guess I wanted to pick up on the cost element, because I think we've sort of been talking about this from various points of perspectives. The cost of compliance, the cost of greater transparency, the cost of due diligence, and all those points I think are very valid, and it's worth having that discussion. I would like to conclude though with the point that not having those things also has a cost that is in fact far greater, as we've seen in the scandals that have erupted, in the loss of confidence, in and the resulting costs for example, very pricey PR campaigns and things like that. So I think it's a question of balancing the costs properly.
Juhani, great, thank you. Nice final point. Inês, over to you. What are some closing remarks?
Thank you very much. I would just say I think it's been from a transparency angle, it's been clear from the discussion that there has been progress on commodity trading transparency, while there's also significant opportunities for improvement, and everyone does have a role to play. And the tools are there. There are good practices. There are guidelines, templates out there. So it's just for trading hubs, companies, and banks to take action and match the progress made, in particular by research-rich governments, in disclosing more information on their financial transactions related to purchases. And we're looking forward to seeing others join in and take the lead on this front. So yeah, I do think it is a space to watch, and a lot of interesting areas to work on. Environment has been discussed. Another area that wasn't touched on so much but was reflected in the report is resource-backed loans and transactions related to that. So yeah, I think it's a space to watch.
Inês, thank you very much. Ben, over to you.
Sure, thanks, Ed. Yeah, and I think just on this issue of transparency and data's usefulness, I think the example of ING's work on KPIs really highlights how this isn't just an issue of cost or a compliance burden. There are real opportunities here as well. And in that respect, I would say that our work on uptake is really just the beginning. We also, some of you may have seen, we released an M&E framework, monitoring and evaluation framework for the guidance. We're also going to be looking at impact. So that's hopefully where we can start to see sort of how commitments translate into action, and eventually how implementation leads to impacts. And in that regard, I think making sure that we're generating enough data, that there's enough disclosure in order to actually inform KPIs and if KPIs are being met. I think that's an avenue that can be helpful both for stakeholders at large and hopefully for traders as well to be more engaged.
Great, thank you, Benjamin. Jennifer, finally, over to you for some closing words.
Okay, thanks, Ed. I think, as you say, Ed, it's a space to watch, and I would say that I am optimistic that the kind of snapshot of movement that we saw in the study is really part of a longer-term trend. And by that snapshot of movement, I mean we've noticed that a number of companies that we assessed have introduced recently these systems and have introduced recently more public disclosure. So that kind of industry shift alongside the increased guidance, increased clarity, and increased attention by downstream actors, I think is all going to point in the right direction. I think also what we've seen from our RMI reports, the companies do respond to these kind of comparative analyses. All I mentioned, they don't like to be in the bottom of the list, although even though we like to look at the vertical space between what companies are doing and what the society expectations are, in a natural way, companies look at how they compare to their peers. So I think we've seen that there is in a way, it's a kind of free gap analysis for these companies, and I think that I think it's a bit of a value for themselves just to see where they can improve. And certainly, I would hope that in the future, and in fact for the next edition of the study, that we would be able to see and track significant movement. And then finally, I just look forward to future discussions that we're having here, and in seeing as well how we together can actually encourage more continuous improvement right across the commodity value chains. Thank you.
Jennifer, thank you very much. And thank you once again to all of our panelists, Benjamin, Juhani, Inês, Camille, and Olle as well. Thank you to all the participants, for the hundreds of participants that we've had. Thank you very much for all your questions. Apologies if we haven't been able to answer all of your questions, but watch this space, but also don't just watch this space. This has been a call for collective action and working together to progress the sector, and we look forward to exciting things ahead. So thank you very much for joining us today, and goodbye.